Hello and welcome to this video in our financial accounting series. In this video, we are going to focus on merchandising activities, primarily inventories. Okay, so merchandising companies. Let's first talk about how they differ from manufacturing companies, okay? A manufacturer is going to buy raw materials and then they are going to do some sort of additional work to those raw materials in order to create a finished good. Okay, in contrast, merchandising activities are companies that simply buy finished goods from one party and then resell them to another party. Okay, so it could include wholesalers or distributors that buy from the manufacturers and then sell to retailers, or it could simply be retailers. These are firms that buy from the manufacturers or the wholesalers and sell to consumers. These are the places like Walmart and the grocery store, places that you and I shop. So these merchandising companies are going to carry inventories on their balance sheet, okay? And the inventories are normally going to be pretty significant. So let's talk about some basic principles for reporting. We're going to look at consistency, disclosure, materiality, and conservatism. So the consistency principle basically states that a business should use the same accounting methods and procedures from period to period. In just a moment, we're going to talk about some different methods for inventory costing. And so the principle of consistency would say that they should use the same method year after year unless they have some sort of, very legitimate reason to change. And if so, there's a whole process that they have to go through to change, but that is well beyond the scope of this video. So we are going to stick to the assumption that they should be using the same method consistently from period to period. Because consistency allows investors and creditors to compare their financial statements over time and make some assessments there. So according to the disclosure principle, financial statements should report enough information for outside readers to make knowledgeable decisions about the company. Information should be relevant and it should be represented faithfully. All right. The materiality concept states that a company should perform strictly proper accounting only for items that are significant to the business's financial situation. Okay. You may be thinking, well, wait a minute, isn't every single dollar material? Well, when it comes to really big companies, we're talking companies that have billions of dollars in revenue. $5 may not be material. And so in that case, they may have, for example, policies in place that, if an expenditure is below a certain threshold, maybe they're not going to capitalize it on the books or something like that. So that's really where materiality comes into play. We just want to make sure that everything is materially correct, and that materiality threshold is going to vary from company to company, often depending on the size of the company. Now, the principle of conservatism means that a business should report the least favorable figures in the financial statements when two or more possible options are presented, okay? So it doesn't mean that we should, intentionally underreport things in the financial statements, but what it means is if we have two equally likely options, we should choose the option that is the least likely to overstate net income or overstate assets. Okay. Now, as you might imagine, it's really important to have internal controls over inventory. Okay. And this is true for both internal and external threats. Inventory is one of those things where we have threats coming from both directions. Okay. Employees could intentionally engage in behavior that could threaten our inventories. And unfortunately, customers could engage in behavior as well, such as shoplifting or something like that would threaten our inventories. So good controls over inventories are going to help to ensure that inventory purchases and sales are properly authorized and accounted for in the accounting system, and it's going to help to protect those inventories that we have in the system. Okay, so we're just going to go over just a few things that companies should really think about when looking at internal controls. Access and authorization is huge. The company has to make sure that merchandise inventory is not purchased without proper authorization. That means including purchasing only from approved vendors and within acceptable dollar ranges. After inventory is purchased, the order should be tracked and properly documented when received. At the time of the delivery, a count of inventory received should be completed, and each item should be examined for damage. Damaged inventory should be properly recorded, and then it should be either used, disposed of, or returned to the vendor. Physical counts. Physical counts are very important. As we're going to learn, regardless of what type of system a company uses, they really need to perform regular physical counts of their inventory. Textbooks generally mention it should be completed at least once a year, to help track things like shrinkage, theft, damage, errors, all of those things. I would say most companies do physical counts far more frequently than that. Some do cycle counts, which are like continuous counts of certain items of inventory. Some do quarterly counts. It really varies, but at least once a year there needs to be a physical count. And lastly, when sales are made, the inventory sold should be properly recorded and removed from the inventory account. And remember, that's the entry where when an item is sold, we have two entries that are made. We record the sales, and the other piece is the cost of goods sold. We're going to move that cost out of the inventory account, which is an asset, and move it into cost of goods sold, which is an expense account. So it's important to make sure that those transactions happen and are recorded properly. All right, so we look at two different basic inventory systems, the periodic inventory system and the perpetual inventory system. Under the periodic system, basically, we're only going to update our accounting records for purchases and sales at the end of an accounting period when we do a physical inventory count, okay? Under the perpetual inventory system, records are continually updated. Every time a purchase is made, every time a sale is made, the accounting records are constantly being updated. Okay. Now, as you might imagine, the perpetual inventory system is far superior. I would say that the periodic inventory system, this is only going to be used by very, very, very small businesses. Especially within, say, the last 10 years or so, we have seen very rapid technological advances that enable even most small businesses to use some form of the perpetual inventory system. There are apps that allow small business owners to scan, to scan merchandise on their phone, to accept, payment on their phone. And so basically, anytime a company can get access to, software that allows them to scan goods, they're probably going to be able to use a perpetual inventory system. And that is definitely what is preferable. Again, there may be some very small businesses out there that are using the periodic inventory system, but I would expect, all medium and large size companies are going to be using perpetual, and even a good portion of the small businesses are also going to use the perpetual inventory system. It's just better. It allows them to properly track their sales and their purchases and know exactly what they have on hand at any given time. All right. So now let's talk about establishing inventory cost, because we have to know what we are going to capitalize on the balance sheet. Okay. So what is included in the cost of inventory? Generally speaking, the cost of inventory is going to include whatever the invoice cost is, adjusted for discounts, adjusted for any additional costs that we might incur, such as, shipping, storage, insurance, freight in on that merchandise, that type of thing. And again, this is what I mentioned on the previous slide. The expense recognition says that when the items of inventory are sold, we're going to move them out of inventory and we're going to move them into cost of goods sold on the income statement. So essentially, the inventory is going to move from being an asset on the balance sheet to an expense on the income statement. All right. So when we are moving those cost of goods sold out of inventory on the balance sheet into cost of goods sold on the income statement, we are going to have to make some assumptions with regards to cost flow. Now, let's talk about that a little bit. Why do we have to make some assumptions? Well, for the most part, a lot of times inventory is not necessarily distinguishable to the extent that you know exactly which unit is moving at any given time. And sometimes, even if it is, it may not necessarily be cost effective to track it. Okay. As an example, okay, let's think about Walmart. Okay, and how many 2-liter bottles of Coca-Cola they probably have in their inventory at any given time. Okay, for all of the Walmarts. Okay, it's a lot, right? And for the most part, these bottles are indistinguishable. You know, one 2-liter bottle of Coca-Cola is the same as another 2-liter bottle of Coca-Cola. You know, there's no way to tell them apart. So we have to start making some assumptions about which items are sold, okay? Because now, especially in times of inflation, okay? Because let's say that, Walmart buys a big shipment of 2-liter bottles of Coca-Cola one week, and they pay $1.05, for those bottles. And then the next week, they get another shipment in, and they pay $1.20 for these bottles. Okay, and all of these bottles are out there commingling on the shelf. Okay, so when they sell one, they don't know did I just sell one of the $1.05 bottles, or did I sell one of the $1.20 bottles? And I'm just totally making up these costs. I have no idea how much they pay for their goods, but you see where I'm going with this. They don't know exactly which one they sold. Okay, and that's just an example, but you can see how that would apply for just about any company. They don't always know exactly which unit they sold, and they don't always pay the same for every single unit because costs fluctuate, right? So we have to make some assumptions about how the costs are going to flow from inventories into cost of goods sold. Now, the biggest thing that I want to point out here is this is just a cost flow assumption. It has nothing to do with how the goods are actually going to be sold. We are just focusing on how the costs are going to move, okay? We have 4 basic options. We have the theory of first in, first out, meaning whatever we bought first, that's what we're selling first. The opposite of that is last in, first out, meaning whatever's the most recent thing we purchased, that's what's heading out first. We have the weighted average, okay, which takes an average. It says, okay, well, let's look at all of our bottles of Coca-Cola in inventory and what's the average cost per unit, and that's what we're going to transfer every time, okay? And then you have specific identification, which focuses on specifically identifying every single item that you sell, okay? So I'm not necessarily going to talk about these in order, okay? Let me start down here with specific identification, all right? This is one that is not commonly used, okay? Because it's just not practical for most companies. The only way that specific identification really works is if you are selling a low volume of high dollar goods, and you can realistically track every single one of them specifically, okay? Common examples that you normally see, excuse me, in textbook world are going to be things like, maybe a high-end jewelry dealer or a high-end art dealer. Something to which we can probably all relate would be maybe a car dealership, okay? Because cars have a unique vehicle identification number, on them, right? And so, it would be very realistic for a car dealer to keep up with exactly which vehicle they're selling, and they would know exactly how much that vehicle cost them. Okay, so those are pretty much the only types of businesses that you're going to see use specific identification. Okay, so for normal businesses, they really have three choices instead of four. Okay, because again, this is not practical for most businesses. So now we have FIFO, LIFO, and weighted average. Okay, well, FIFO, I think the reasoning behind this one is pretty obvious because FIFO is going to generally match the physical flow of goods. Okay, companies are pretty much always going to try to sell the items that they purchase first. They're going to try to sell those as early as they can, right? They're going to sell stuff in the order that they bought it in most cases. So FIFO tends to match physical flow. That's kind of the advantage there. Now, you may say LIFO, that makes no sense at all, okay? And from a physical flow, it would not make sense, okay? No company is going to use LIFO for a physical flow. And this is why I said we're just focusing on cost flow, okay? All companies are going to be selling their oldest goods first, okay? But when we're talking about cost flow, here's where LIFO starts to make sense. What LIFO does by saying, okay, we're going to take the most recent cost, and that's what we're going to assume sold. At any given time, it's matching current cost with current revenue. Okay, so in theory, LIFO gives you a better match of revenues and expenses. And that's the whole theory or logic behind LIFO. Again, not a lot of companies use it. And interestingly, companies that are subject to international financial reporting standards, also known as IFRS, the LIFO method is not even permitted under IFRS. Okay, so if a company reports under IFRS instead of US GAAP, they are not permitted to use LIFO. But you will still find some U.S. companies that use LIFO. Again, the theory is it gives you a better match of cost and revenue. So that leaves two left, FIFO and weighted average. These are the ones that most U.S. companies are going to use. And honestly, for most companies, it wouldn't make just a huge difference either way. You guys know how costs behave. Costs do fluctuate. They go up here and there. But for the most part, it probably wouldn't make just a tremendous difference in terms of, tracking our inventory cost, which method we use. So you'll see companies that use FIFO. You'll see companies that use weighted average. I would say you'll probably see FIFO a little bit more often. But advancements in technology has made it a lot easier for companies to use weighted average. When you're calculating it manually, weighted average is a bit cumbersome. But again, some of these high-tech, inventory tracking systems can do it pretty easily for you. So you do see more companies nowadays starting to use that. All right, last thing that we're going to touch on is this idea of lower of cost or market. Okay, and this goes back to the overarching principle of conservatism. Okay, we do not want to overstate our assets and mislead investors or other financial statement readers. Now, we know that we normally use the historical cost principle when we are recording assets such as inventories. All right, well, what lower of cost or market says is, okay, yes, you're going to report your inventories at cost, but if something happens and the market value of that inventory falls below the cost, then you're going to write it down and you're going to carry it at that lower market value instead of carrying it at cost. Okay? Now, the market value is normally determined to be the net realizable value of the goods. Okay, so basically what you're going to do in most cases when you're assessing lower of cost or market, you're going to look at the cost of each inventory item. You're going to look at the net realizable value for each inventory item. As long as the cost is lower, you're good. You're all set. You don't need to do anything. But for those items where the net realizable value is lower than the cost, okay, maybe, like for example, maybe a company's sitting on like some really old inventory. Maybe it was trendy at one time and it's not anymore, and the value's just really plummeted. Okay, that's the type of situation where net realizable value may be lower than cost. You're going to write that item down. Okay, so maybe the store paid $20 for it when it was really, really trendy and they were selling them for $50, like hotcakes. But maybe now it's out of style and nobody wants it, and they do well to sell it for $10. Okay, they can't continue to carry it for $20 on the books. They're gonna, if net realizable value is $10, they're gonna have to write it down to $10. And so that's just the basic theory there. We're just going to record whichever one is lower, cost or market. In most cases, cost is going to be lower, but we do have to make that evaluation and adjust for any items that might have fallen below that cost in terms of their market value. All right, so I appreciate you guys watching, and I hope that this lecture has been helpful.